Hi everyone, this is KT. Today I'm going to give a lesson on understanding what is the most effective strategy for maximizing profit with limited initial capital. As you can see here, there are three strategies, just naming it scenario 1, scenario 2, and scenario 3. Scenario 1 is actually using your cash to buy shares for the long run. Scenario 2 is using borrowed funds, you call it leverage, margin, or debt to buy more shares than those you could buy with just your available capital. Scenario 3 is using derivatives or example options, using your available capital to buy these options rather than the shares themselves. As you can see, scenario 1 has limited profit, limited risk. Scenario 2, high profit potential, high risk. Scenario 3, high profit potential, limited risk. So the most effective strategy for maximizing profit with limited initial capital will be scenario 3. Using derivatives, example options to uh, to buy the to use options rather than the shares themselves using your initial capital. Let's use a real life example like Tesla, which is currently trading at $465.50 now. So using scenario one, we purchased Tesla shares with $46,500. The number of shares we could get is 100 shares. Take the initial cash divided by the Tesla stock price. The profit for Tesla uh, after 1 month, if Tesla's price rose to $500, it will be 100 shares times $500 minus $46,500. You get a positive $3,500 into your pocket. If 1 month later, Tesla drops to $200, your loss would actually be 100 times $200 minus $46,500, which is your negative $26,500. Next, if you are using borrowed funds for scenario 2, well, for this scenario and with this example, we have an initial capital of $46,500. We borrow four times, which is $186,000, and with an interest of 3% incurred with the broker. So the number of shares that you will get is 46,500 plus 186,000 divided by the Tesla stock price of $465.50 equals to 500 shares. The profit in 1 month later, if Tesla stock price is $500, is 197,920. This is calculated by 500 shares times $500, which is the stock price 1 month later, minus the initial cash on hand, $46,500, minus the interest incurred, 3% of 186,000, and minus the amount borrowed, 186,000. So what happens if 1 month later Tesla drops to $200? Your loss is $138,080. The same formula, you just take 500 shares times $200 minus the initial cash on hand, minus the interest incurred, and minus the amount borrowed. Next, for scenario 3, if we are using options. So this is an example with initial capital on hand, $46,500. We purchase a call option of Tesla, expiring 1 month at the strike price of $465.50 at the money by paying $2 per share. The amount of shares that you will get is 46,500 divided by $2 equals to 23,250 shares. Now, what is your profit if Tesla is $500 in 1 month's time? So you have purchased a call option of a Tesla at $465.50. So you would exercise the options on hand, which means that you will have 23,250 shares, and Actually, it means that you buy 23,250 shares at $465.50. Then you will sell those shares at the current market price of $500 and earn the difference. With this difference, you minus the premium paid or the $2 per share, which is $2 times 23,250 shares, and you'll get a total profit of $778,875. Now, what's the profit if the Tesla stock price is $200 in 1 month later? For this, the options actually expired. I wouldn't say uh, expired. It's just that you simply don't exercise the option because it doesn't make sense to exercise it, purchase the shares at $465.50 when the current Tesla stock price is $200. So what is your loss? It's actually just your capital initial capital outlay, which is $46,500. So as you can see, scenario 3 gives you high profit potential but limited risk. So for scenario 1, which is just longing equity, it just means that if the stock goes up $35.50, you will make $35.50. Vice versa, if it goes down $35.50, you will lose $35.50. So both the profit and loss are almost the same. Next, with debt for scenario 2, it is actually a double-edged sword because it definitely can increase your gains exponentially when the stock moves in your direction. But you can also incur big losses that goes beyond your initial capital, meaning that you may end up not only wipe out but also owning money. Now, scenario 3, using derivatives like the call options allows us to multiply the profit very significantly without the need to have more capital. And also, additionally, the loss is always capped at the capital you had. So, unlike that, you cannot lose more than you had. So, the most effective strategy for maximizing profit with limited initial capital will be scenario 3. And that is the reason why, with limited capital, it is more wise to use options